We are live. Good morning. We are with Travis Goltz with Granite Bank and my son Boston Olson. And my name is Nate Olson. I am with the Level Up Podcast Show. We're excited to get started. So Travis has a wealth of knowledge, 23 years in the mortgage industry. So we're really excited for the viewers to be able to get an inside look on some of the tough questions within the industry right now. And I will let Boston take it away with some of those.
Yeah, man, it's going to be a fun day. I think we got a lot of good questions to ask. Hopefully you guys find some good stuff out of this podcast here. When, maybe you're buying a first home or maybe you've bought a couple homes, I think anybody will be able to get a little bit out of this podcast today. So make sure to stay tuned. We got a lot to talk about today. But yeah, Travis, to open up, what's the biggest lie people believe about buying a house right now?
As we talked about before, it's a little bit of a tough question. There's a lot of myths. I don't know if I want to say lies, but myths of how people want to direct you in ways of buying their house or buying that house or getting into this rate or that rate. I think the biggest thing is educating yourself, understanding and knowing what's real and what's not, and understanding what works for you and what doesn't.
Yep. Beautiful, beautiful. And if someone is waiting for rates to drop, are they already losing?
I think that kind of goes back to the same thing where it makes sense to you today at whatever rate it is. If it's 6% or 5.5% or 6.5%, is that house that you're buying the house that you want? Is it something that you're going to be excited to be in? Is it something that you want for your family? Mm-hmm. So there's so many different parameters of that. Of yes, are you losing in one way but gaining in another? Because you might be gaining in something that you wouldn't be able to get in a different market. Mm-hmm. And then the spring market, all of a sudden that house is $20,000, $30,000, $40,000, $50,000 more and you can't afford it.
Yeah.
Another hard one. You can always refinance.
Yep.
You can't, if you look at the history of values of properties, the value is going to go up. You're going to go backwards if you wait longer. Mm-hmm. So no matter what that rate is, get in. And if the rates do drop, refinance into that.
I think that kind of goes straight into my next question. And you kind of talked about it a little bit answering that question. Is buying a home in 2026 actually smart or stupid, would you say?
I think it's smart. It's smart if you're in the market to purchase a home. If you're not ready, it doesn't make sense in any year.
Yep.
So really, that's the biggest piece to it.
And then what's the worst financial advice you hear on TikTok or any social media for that matter about mortgages?
I was going to say I'm not on TikTok, so I don't know. But there's a lot of myths. So going back to your biggest lies, I think on social media, there's a lot of things that trick people into calling and going forward with certain things. I think trusting and knowing who you're working with and understanding that they know the market, they know what they're doing is the most important things, because a lot of things on the internet are what?
Fake.
Right.
Yep, for sure. Going into our kind of next section, mistakes that cost people thousands. So my next question to you would be, what's a mistake that you see buyers make that cost them $50,000 plus when buying or selling a home?
Not using professionals when you're buying a house. Inspectors, a good realtor will push you, or not push you, but help you make the right decisions on homes. Understanding neighborhoods, understanding the quality of the house, understanding all those pieces. Also then getting into a loan that's correct for you. If it's a short-term, long-term, whatever it might be, those are all decisions that, again, you want to talk to a professional that's been doing it, that does it full-time, that's in it every day, their advice and what they want. If you're asking for it, they're going to give it to you, and that's important.
Yeah. I couldn't agree more. Do you have anything to add on that?
No, I don't. I think that's great. It makes sense.
Awesome. And then next, what purchase looks affordable but actually isn't?
What purchase?
So like if someone's looking to buy a home and let's just say it's a little over their budget, what's kind of a mistake that maybe first-time home buyers or, people that are looking for a home end up paying maybe too expensive of a home and then get smacked down the back end?
It goes back to the professional that's helping you when you first start being at a loan officer or lender or whatever you want to call it. Understanding that people are usually approved for more than what they can or want to pay each month. So the first question I ask most people is, what is your comfortability with your payment? right? That's really what you have to look at first before you go look at any houses.
Yeah.
Because once you look at that house, that's maybe $50,000-$100,000 more than what you want to spend. You like that house. You don't want to go to the house that you want to afford. So if you don't ever know that it's there and understand that and know what your budget is, because the last thing I want to do is put somebody into a house, especially their first house, where they can't afford it. They don't have any other avenues of paying for it. That's detrimental to their future.
Yep, for sure. And then what's the fastest way to get denied for a mortgage, would you say?
Miss a payment, quit your job, buy a car. 3 things.
Those 3
Don't
things.
do it. As soon as you're interested in buying, if you're planning on quitting your job or planning on transferring your job, do it afterwards. As long as it's a job that's gonna make you more money or better, don't do that in the middle of a transaction. You would be surprised how many people call. So I'm taking a new job. You're buying a house in 3 weeks. Does that make sense? Probably not. Those are big things. Don't do anything that's going to change your income or the debt that you have to pay each month.
Yep. For sure. I couldn't agree more with that. What's something that buyers think helps their credit but actually hurts it?
Well, we'll tell you that credit cards are the biggest change in credit. So if you've balances, anything over 18% of your limit is going to affect your score. It also is like one of the best things when I look at it and somebody's got a little bit more of a balance on their credit card, where I can take and say, hey, pay this down. You're going to get the most movement for that credit. So that's a hard question.
There's kind of a give and take there.
It really is, yeah. But don't miss a payment.
Yeah.
Mortgage payments kill you.
And the credit card history can help with early, like the younger generation. That's a big hack. Like a parent can add that child onto their credit card as long as they're a responsible parent, of course, that they're making and it's staying underneath that limit, don't have any lates, but it will affect.
It's a great thing a parent can do for a kid is to teach them that, right? Have that 10 years of having a credit card and they've got under 18% limits on it. It really can shoot your score up and give you that ability to have that good base for your credit and then build from there. We'll get into another one of those when we do some credit analyzing or credit teaching that we're going to do, because I think that's important.
Yeah. And then I guess a good question to bounce off of that. If someone is looking to get a mortgage, what is like the lowest credit score you can have to get into the home that you would like, right?
Well, if you look at guidelines, there isn't a minimum.
Okay.
If you don't want to pay astronomical amount when it comes to fees or interest rates, depending on your type of loan. So if it's an FHA loan, probably, I would say a 620, 640. You get into lower scores, you can get approved. We can do the loans. It costs more.
Yeah.
So that goes back to that whole like detrimental to them in the future. Right? Am I going to advise that? No, I'm going to try to help them fix their credit, get the things. Maybe a parent can help out with a credit card like we talked about, or get to that point. So those are big things.
Okay.
Yeah.
And then this is kind of like a myth buster section. Do you really need 20% down, or is that outdated nowadays in 2026?
I think it's been for a long time. USDA is 0, VA is 0. FHA is 3.5. Conventional is 3% if you're a first-time home buyer. So no, there's a lot of programs out there that you can do little or way less than 20%.
Okay.
Now, if you don't want mortgage insurance is going to be something that's going to, again, be a big thing if you don't have good credit. If you don't have good credit, that rate is going to be higher. You're going to pay more. You get some people that are paying $200-$300 a month because their credit score is low. If you have good credit, it can be $30-$40 a month. It's a big difference.
And then what's your opinion on, or I guess what would you prefer? And give me a little bit of your insight on this. Would you rather, or what do you think about a 30-year loan versus a 50-year loan on a house?
I think it's a gimmick, my opinion. They tried the 40-year term 20 years ago or 30 years ago, maybe. It works, but you go backwards. We went through a time where in 07, 08, where we had a crash. Big loans then were neg am.
Yep.
So you're going backwards when you're paying your payment. You're doing arms to try to get those payments less. Is a 50-year mortgage good or beneficial for somebody that's getting into their first house to keep their payment down? Probably. Hopefully you don't stay in it for 50 years
Yeah.
or any longer because you're going to pay
Interest, right?
interest.
Yep.
Yeah.
Sweet. And then is retiring actually throwing money away?
Oh, renting?
Or renting, yeah, not
Retiring.
Okay, let me
Retiring.
retire that. Okay.
No, I
so-
think retiring is throwing away money.
yeah, that's what I would say. You're not working, right? Okay, so is renting actually throwing money away? Or what is your opinion on that?
It depends on, I don't think some people should buy. I think there's a point in people's lives where they don't know where they want to live. They don't have the job they want to be in. They don't have the money for the down payment, and they don't have the money after the down payment to take care of the house. So sometimes I have conversations with borrowers that they want to buy their first house. They're excited about it. And then when I ask them about the money they've saved up, oh, we haven't really saved up any money.
Yeah.
Oh gosh, it's hard for me to say, then you should buy a house.
Right.
Right. Without it, with like thinking about it as my kids.
Yeah.
Going, yeah, go buy a house, because what happens if your furnace breaks down? What happens if you're, whatever it might be, there's expenses when you buy a house. It's not just paying the mortgage.
Exactly.
So in some senses, yes, literally you are throwing your money away,
Yep.
but you have to live somewhere, right? So if buying something and maintaining, or you don't have that mindset to do that right now, it's not bad.
Yeah,
There's just circumstances that make sense.
I think you should have 6 months of reserves of whatever that mortgage payment. I think it's a really good idea.
Everybody that, because then we won't ever have anybody buy houses.
Yeah.
Just kidding.
Yeah.
But for like a younger person,
Yep.
if they save that up and they've got, some money set aside in case hard times do come about, that way they're not in a position where they're going to lose the house too.
Yep.
I think it's really important that when you buy a house, first or second or whatever, that you find a good, like here locally, Excel Energy or any of your energy or power gas companies have a service where they do like warranty stuff.
Sure.
Where they'll come out and fix something if it doesn't work or whatever else. You pay a smaller fee each month, and then they've got like a $50 deductible.
Yeah.
Those are huge when it comes to that, because then you're not they also have like where if something goes bad, furnace, refrigerator, whatever, it's a higher number.
Yeah.
They have where part of that, there's money that can go back into it. So you've got a little bit of help there. So I think that's important. I think a lot of people push the whole first year. I think it's something that they should have forever.
Yeah.
Because there's little things that pop up all the time. And what's a service person cost?
Exactly.
$400 or $500 every time they come out to your house to fix one little thing.
Yeah.
Right. And if you don't have those extra money and you're on a fixed income, it's hard.
Yeah.
So to do something like that and make sure that that's happening is super important.
And then going on to the next question, this is a good one. Is it smarter to put more down up front or keep cash for later?
Great question for a financial planner or on that side of it, just because of the fact that depending on the interest rates, I think the interest rates when they're closer to 8, I would say put more money down.
Yep.
The lower they go, the more money I think you can diversify into something else that can make you that much or more money on something else. So offsetting that. I'm not saying that so your mortgage is higher so I make more money at all. Because I would always recommend putting, more money down, because the more over 25% is where you start getting your savings when it comes to rates. So if you can do that aspect of it and put more money down, fantastic. But if you're under 20% and you're like contemplating, I'd rather see you have the reserves and have the backup if there was something that happened than to put more money down.
If you intend to keep the mortgage, you lock in at a really low rate, and you want to even offset that rate even lower, is it still a thing to buy that rate down with some of that additional cash? I mean, is that which way do you think you'd come out further ahead then?
You have a crystal ball.
No, but
The biggest thing is that buying it down right now. So like in the markets that we are, what did we lower the rates 4 or 5 times last year?
yeah,
So if somebody started out the year and they paid 7%, but they paid $5,000 to buy down that rate to whatever, 6.625 or 6.75.
yeah,
And then all of a sudden the rates 3 months later went to that low rate. Now you just threw money away.
Right.
So it's hard. If you don't care and you're like, this is my decision, this is what I'm going to do, fantastic. You know what you're doing. I'm more of a gambler like that, where like I don't like to gamble, but like on this kind of stuff, if I see and kind of watch the market and see that the rates are going to come down, I'd rather watch it and wait than it would the other side.
Yeah, that makes sense.
Again, that's my opinion. Everybody has their differences in what it is, but if you look at it financially, I think it's better to wait and watch it.
I think life changes too. Like you have certain expectations on how long you're going to stay in the house or how long you're going to stay at that job, and life changes. So I think rather than putting that money to buy the rate down with how much they can fluctuate, it'd be smart to probably put that money either towards, again, it could be a financial advisor question. Can that cash in an investment, in the right investment, offset that difference to where, it's not all into that mortgage.
Yeah.
Could be.
Yeah, it's a great question to ask them because they'll give you what especially in January, right?
Right.
What were your gains last year in in the markets?
Yeah.
Was it 6%? Was it 10%? Was it 3%?
Right.
Right. Then you can kind of make a decision, educational decision.
Yeah.
That way.
Yep.
What do you think?
I think you guys brought up some good points. I'm going to let you guys be the professionals on that one. But going on to the next question, are adjustable rate mortgages as risky as people think?
It all depends on, like if I would say as an investor or a savvy person that had homes, had mortgages and understands the concepts of it, I think that you do it for a short term if you're going to keep the property for a short term. Or if you understand the markets more and you know that in 3 years the rates are going to be way lower. Again, crystal ball, right? Understanding what that might be, who knows? Risky, right?
Yep.
You're gambling. Way better than it used to be when you had a 2-year ARM with a 3-year prepayment penalty. Do you understand that concept?
Tell me a little bit more about that.
So you have a 2-year ARM, so it's locked in at 2 years at whatever that rate is. Let's just say it's at 5.5 or 5%.
Yep.
After 2 years, it adjusts, and whatever it might be, 0.5% a year, 1% a year, whatever that mark. If the rates go way up, it could go up to whatever that cap is on that.
Yep.
Now you're stuck for that next year at least. Sometimes they have a 2-year or 4-year prepayment penalty. So if you try to refinance after those rates go up, you have a big amount of money that you have to pay, right?
Yeah.
In Minnesota, you can't have that anymore.
Okay.
So it's safe that way.
Okay.
So it doesn't exist anymore.
Yeah.
But an ARM there's places for it, and there's people that use it on all the time, and that's okay, right? Short term.
Maybe that's like a good spot when the markets are super down, and you know that they're going to get better, or is it vice versa where maybe you want to do that when they're super inflated?
I think now is a good time to do something like that if it's going to be a short-term thing.
Yeah.
Like if we do a portfolio loan, it's a short-term loan, right? So it's an ARM.
Yeah.
So it's something that's going to adjust, or it's going to be called due, like the notes going to be called due after, like, say, 5 years.
Yep.
So at that 5-year mark, you either have to refinance or pay it off. So, but those are, you do that on riskier, making sure that you understand what you're working with. It's going to save you money over a 5-year period. Let's go.
Yeah.
Right? Because I'm only going to be in the property for 3 years. But I always say, if you plan on being in the property for 3 years, it's going to be 6. You never have that same mentality always. You always give yourself a few years of leeway in case something comes up.
Sure.
So that's important.
And is that for would you say in your experience dealing with people that have done that, is that people that want to stay in that house, or is that to refurbish and get out of there? What?
I would put it more for if you're going to redo it, save money because you're putting money back into it, and then redo it, and then take the value of what it is when you're done with it and refinance into a longer term.
That's what I was thinking. Okay.
Yep.
Sweet.
Or get rid of it, right?
Yep, exactly. Yep, exactly. Sweet. On to the next question. Does having student loans automatically kill your chances of getting a loan?
I think it makes it harder depending on how much money you've spent on student loans.
Yep.
I would say a majority of the people that have student loans have big payments. And I don't know what the percentage is, but it's pretty big that the people that depending on your degree, they're not even in the job that they went to school for.
Yeah.
Right. And you spent $100,000. I sat down at the table with 2 doctors one time. Their student loans were over $1 million.
Wow.
That's crazy.
Right. So they could afford it. They're both
Yep.
a brain surgeon and a psychologist. So they made good money. So it was fine. But it was another mortgage payment. But the people that are in college or that just got out of college or whatever it might be, they're now behind the 8 ball because of the whole, they've got $100,000, $200,000 worth of student loan debts that their payments are there. Now they've done a lot of different things with payment plans and income-based payment plans so that you're not hitting with that huge payment so that you can afford some of that stuff. But understanding that, knowing that, because a lot of them will say they're deferred, but if they're not deferred for 3 years, you have to use the whole amortized amount. So that throws a lot of people out of qualification. So yes and no, but you just, again, having a conversation and putting a plan together. Don't call me 2 weeks before you want to buy a house. Let's talk 6 months before.
Yep.
So we can put a plan together, figure out what those student loans are, if we've got to get it into a different payment plan or we got to figure out some other aspects of it. Let's put that plan together so that we know what we're doing and we have set aside so we can make sure we qualify for the house that you want.
Great. I think that's going to help a lot of people looking for that guidance for sure.
Yeah.
Moving on to our next category. I got a first question here for you. This can be maybe a tricky one, but what salary do you actually need to buy a $400,000 home, $400,000 home?
Wow. What neighborhood? What's your credit like? There's so many questions and so many things. That's a really loaded question. I want to tell you, but I'm not going to tell you.
I know it's pretty broad too.
It is because there's so many people around that have different credit scores, right? They have different debts. So you have a car loan, you don't have a car loan. I have 4 car loans and a couple credit cards and some student loans.
Yeah.
So you can afford the $400,000 house. You can maybe afford it. I can't.
Yep.
Do you know what I'm saying? So there's so many ways to look at that. That's such an open-ended question. The biggest piece to it is I had a conversation yesterday with a realtor that I met that's from Denver that moved here. And she's like, hey, I want to buy this investment property. I'm like, okay. So let's get all your information. Let's make it, put a plan together. 'Cause that's really the answer.
Yep.
Right? Unfortunately, it takes a little bit of time and a little bit of effort, but I'm not going to understand and know if the 3 of us can afford that house until we fill out an application and figure that out.
What are some
Sorry, I didn't mean to not answer the question.
No, that answers my question. Going off of that, what would you need from those people as far as, let's just say, the application process? What are you looking for? Maybe five things that you're looking for to be able to qualify someone.
Credit, job history, payments, payment history goes along with credit. It's really the biggest things, those 3. The rest of it, most people I can talk to them and I can figure out what they're qualified for because they're not going to lie to me. Because unfortunately, after about 15 minutes, I know more about them than they do them.
Yeah.
So tell me the truth. Just tell me what everything is, and I can pretty much tell you if you're fine or not. When I ask somebody how their credit is, they're either going to go, oh, it's really good. I really don't know. Or there's been a couple of things.
Yeah.
That's all. You know what the credit is at that point.
Yeah.
And if we got to work on it a little bit, that's why that whole 6 months before you buy, ideally.
Yeah.
We can work on it. We can put those things together and figure that out.
I think signing up for some of these free credit trackers, like Credit Karma is a good one. It's a free app. It helps keep them on track and motivated to keep that credit up too as well. It's kind of a reminder of what they're doing. They'll see that if they go over their 18% on the credit card, for example, they'll see their credit scores drop. So I think that's a really good, probably one of the first things that the younger generation should do is sign up for that app to kind of get an idea and learn, because credit is so important.
It is. It's amazing how much money it can cost you if you don't pay attention to it.
Yeah.
And I blame the parents.
Mm-hmm. Right.
Really? Because the kids don't know.
Yeah.
And a lot of the parents don't know.
Right.
But we're going to do that.
We're going to go through
We're going to go through that.
Yeah.
Which will be fantastic. It'll be good because There's a lot of things that you can do that don't cost any money. Then all of a sudden they buy their first car and it's like, oh, I got 0% interest. The other kid went out and bought a car and it was, you couldn't pick any car except for this one that's going to break down in 2 months, and you paid 18% interest.
Yeah.
Because you have no credit.
Right.
Yeah.
Sad.
Yeah.
It is sad.
Sucks because it's not all on them either, you know, just the way our system works. So.
Yeah, there's no education for it.
Yeah.
Like you go to business classes in high school and there's never a conversation about credit.
No.
Well, I mean, that's a real easy way to put you into a position of really robbing you of your dreams of being able to buy a home someday. I mean, if you get into credit card debt early, it's a trap. You know, a lot of people can't pay it off, and so I think it's going to be a good thing to have a series on that as far as that credit education.
See, like the statistics is for people that are under 30 that get into problems and file bankruptcy, what percentage of that happens in that time frame?
That's a great question.
Because they don't know.
Yeah.
Right. You don't know what you don't know. And then you come up and all of a sudden you're like, oop, I got all this. I bought a car. I bought a house. I bought this. I bought that. I'm like, oh my gosh, I can't afford it.
Exactly.
Oh.
Yep.
I had a furnace go out. I had to spend $10,000.
Yeah.
I don't have $10,000.
Exactly.
Yeah. It can happen quick too, right?
100%.
What's a hidden monthly cost people never budget for?
Huh. Good question. There's a lot of them.
Mm-hmm.
Are you talking about when you buy a house?
Yeah.
Oh.
Or what do you hear? Like, what do people come to you and say based off of your experience? Like,
Taxes going up, insurance going up, utilities being way more expensive, especially in the Midwest in the wintertime, or maybe in the South in the summertime, right? All of those things, they can give you an average when you ask, because a lot of people, a good agent will say, hey, I'm going to ask the sellers what their average cost is for utilities.
okay.
And the average is something, but when you get that $600 bill in the wintertime for gas in Minnesota, because it's 30 below,
Right.
You didn't budget for that.
Yeah.
You budgeted for 200 or 250 or whatever it might be. And all of a sudden it's like, oh, that's a lot.
Yeah.
And then your water heater goes out. So a lot of those things come back to that not home warranty, but like the mini Gasco used to have, the Service Plus or whatever it might be. That was amazing because at least that part of it, you can't help your taxes. You can't help your insurance.
Yeah.
You know, those are things that you file a claim or whatever it might be, your insurance goes up. Those are big hidden costs that might happen or that will actually happen because I get a call every time January, February of every year. Why did my payment go up? Well, they did the rechecking on your taxes and insurance.
Yep.
They had to pay those out. All of a sudden your escrow account is negative and you've got to bring that positive or at least zero, right? Or have 2 months worth of reserves in it.
Yeah.
Yeah.
Now it's another big expense because it's great that they can set it and where they can spread it out over 6 to 12 months. But now your payment went up $200-300 a month.
Yeah. And that's a big deal for people that are just trying to get by, you know?
That's why it's really important to make sure that you have the conversation up front about not going, I want the $400,000 house, but I want the payment of a $350,000 house. Those are huge.
Yeah. Yeah. Because you can get caught in a rut pretty quick. If you make one bad decision, well, there goes your house. Maybe the bank takes it away, you know, because you can't afford it anymore, right?
Right.
So that's
now your credit goes down. Now you're trying to buy another car.
Yeah,
Now
it's a slippery slope, right?
It sure is.
What do you recommend, like, if you qualify for $400,000 and you want to go right up to that max, what would you recommend that to have that little bit of a threshold? Because I think a lot of people in today's world would I want that $400,000 house, but those unforeseen costs like you talked about.
Yeah.
Maybe like come down 20% under that to keep a little safe gap.
I would say, you know, like look at a budget.
Yeah.
Tell you to go back and look at your budget of what if you took out, because a lot of people, especially first-time homebuyers, are coming into this going, I pay $1,000 a month because I'm splitting rent with somebody.
Yeah.
And now your payment's going to be $2,500. How is that going to change your everyday budget? You want to buy groceries. You want to pay your insurance. You want to go on trip. You want to do some fun things. You're young. You want to do whatever. Get out. is that going to affect that? Right? Because you're still going to want to do those things. Mm-hmm. The house is a great thing, and it's a slow process of making money in the future.
Yeah.
But today, is that going to ruin you? Not be able to function or live.
I'm house poor.
And unfortunately, with the prices of houses today,
Right.
a lot of people are. Mm-hmm. So to answer that question, it's hard. If you have another person that's not on the mortgage that's in the house that's paying with you, fantastic, cool, But you got to make that decision and try to figure out what makes sense to you on an everyday basis and really look at that.
Mm-hmm. For sure. Is refinancing ever a bad move, or what would you say about that?
It can be. It costs money, right? Every time you turn around with a refinance, there's money spent.
Yep.
A lot of companies will, be deceitful and tell you it doesn't cost you anything. It doesn't cost you cash money out of your pocket today.
Yep.
But they're taking equity out of your house that you have, that you no longer have. I just sat down with a couple that refinanced a year ago, and they're like, yeah, we want to refinance because the rates went down. And I looked at them and I said, you bought this house 3 years ago. Mm-hmm. You refinanced a year ago. Do you know how much you spent on your refinance a year ago? No, they said it was free. Mm-hmm. I said, well, your mortgage went from $300 to $365.
Yeah.
Does that sound like it's free?
Right.
It was like, and I don't think it was $15,000, but it was probably $10,000 to $12,000 for their refinance.
Yeah.
They looked at me and went, that guy said it was free. Was he local? Did you sit down with him and talk to him? No, it was somebody that called me online and called me on the phone, and we talked to them. They were great. I'm sure they were.
Yeah.
But they didn't explain to you that
Exactly.
you now are stuck. You can't sell your house because it would cost you more money than what it's worth to sell it with paying fees and whatever else. So that's a good question.
I think it can depend on the time too.
Oh, 100%.
I mean, if you've already been paying on that mortgage for 10 years and you locked in at 7% and now you see rates are at 5%, just that number, 5%, doesn't mean you're going to pay less. You're starting your amortization schedule all over again.
Not necessarily, because you could do a 20-year. You know what I'm saying? You could cut a couple years off of that.
You could affect
and make
that
that less
different. Yeah.
But do people do that?
Right.
Especially when you're getting a phone call from, I'm not against online stuff or whatever else, but they're taking advantage of you. So if you can do that and you can look at that and go, I want my amortization to be this. I want my payment to be less. Because a lot of times your payment's going to be more.
Exactly.
Because it's going to be a shorter term.
Yeah.
Or maybe if you can, for me, it's 1%. If you're not going down 1%, don't refinance. Because you're probably going to be doing it too early. A lot of people are pushing right now with, hey, you got a 6.75 or even a 7% rate. Yeah. It's really close.
Yeah.
Be careful. I don't think it's ready.
I think the most important thing would be to call a professional like you that can run don't assume either way. You can crunch the numbers, you can run amortization schedules and be able to show them the difference on that. I think.
But you bring up a great point about the whole going backwards.
Right.
Mortgages are front loaded when it comes to interest. For the first 3 to 5 years, you're paying more interest than you do the rest of your mortgage. So if you start over, you lose.
Right. That's true.
Good question.
All right. So moving on to the next one. Do high interest rates actually help smart buyers or hurt them? And who wins when rates go up?
High interest rates, I don't know if they help anybody. No. I'm going to say no. I don't know why high interest rates would help anybody.
Okay.
They make people more nervous. You might be able to get a better deal, but there's not going to be as many houses on the market.
Okay.
So if you're a savvy investor and somebody needs to get out of their house, cool, maybe that's the time, right?
Yeah.
But that's really the part of it.
It's interesting how interest rates can affect the economy too. How they raise and lower
deeper,
rates.
Yes. If you talk to a financial planner, if you talk to somebody else, yeah. So great point. If you pay a little bit more in your interest in your house, write it off.
Yeah.
Plus you have some money that you have in your stocks or whatever it is, and your amounts go up. So where are you winning? That really is a good point. So I kind of missed on that.
I would say, just to add to that, it can be a catch-22 because you could essentially end up with a better deal on that house because the buyer demand has come down because the rates are higher, where again, we don't have a crystal ball.
Yeah,
But
that
if
makes sense.
if you were to get a better deal on that house because the demand isn't as high and you end up going into a 7% interest rate, maybe that's where the ARM comes into play, where it's smart. You know it's going to be short term. You're banking on either hopefully being able to refinance that because rates are going to come down. You got that spread of equity because you bought the house when there wasn't as much demand. So it could play a positive role in the right, but again, it's a risk on environment that way. If it were to happen that way, it could end up being a good thing.
You don't know how long the market's going to be kind of shaky in that regard too, as well.
It's that crystal ball thing.
Yeah.
So like if you look at the last 2 or 3 years of our market, you kind of see that where you had all these people that in 2020, 21, maybe even 22, got a really good interest rate. Now they don't want to move, even though they've had 2 kids. They don't have the room for the 2 kids, but they're like, hey, I have 0.75% interest rate on my house.
Yeah.
Maybe I should just add on.
Maybe I should just
Right?
add on.
I mean,
Right.
or should take a line of credit or something.
Exactly.
There's so much of that where people are just holding.
Right.
So that kind of depicts a little bit about what you're talking about. Like, is it good or bad? I think a lot of people, if the market goes to 5.5 or even low 5s, those people are probably going to sell their houses.
Right.
Because it's not that much of a difference. And they're making, the value of their house. If the rates go down, prices go up, they're making more money on their house so they can get into that next house too.
Yep, that's true. It'd be interesting to look at the statistics of that because I would think that while rates are higher like that, like I said, with the buyer demand, I would guess like you're getting a lot less like at one point when I had sold a house in Zimmerman, this was, I want to say 5-6 years ago, the market was really hot. Rates were low. I had several offers over asking price. We recently purchased a house and it was just the opposite of that, but the market's down a little bit. Rates were a little bit higher than they were at that point. But I got a better deal on the house because I'm not bidding against anybody else. Because the market's a little
I knew a lot of people that sold in 21, 22 after the whatever, and then came and said, okay, I'm going to wait.
And that's just after COVID, I believe, right? Where they pumped the money into the markets and the economy was thriving.
Right now, like if it happens and they put $200 billion into the mortgage-backed securities, rates will go down. Because
I think that's what the
happens.
Fed's actually pivoting and doing right now, actually.
So we'll see if it happens. You watch the 10-year bonds. That's a big thing to watch. If it goes under 4, we know rates are going to get better. It's got to stay under 4.
And not saying you have a crystal ball, but where do you foresee in the future? Do you think there's a housing crash coming, or is that kind of up in the air, kind of thing that I think everybody always calls for it and it never happens type of thing? Or
I watched it happen, right? In 07 and 08. Well, it happened in 07. Everybody else says 08, but it really happened in 07. I believe that was negligence on the lending side of things, the way that we did loans back then, the way that the loans were done. Like put your wrist up here. I grabbed it and said, you have a pulse. You're approved. They weren't free, but didn't matter. So that putting zero money down, doing all those things. Now we've come back a little bit from that where we're doing some like bank statement loans. A little bit riskier, but you have to put 25% down. Right. So you've got some skin in the game. Nobody had skin in the game. It was 0% down, no matter what kind of loan you did. If somebody said, oh, the rate's going up because they were on ARMs. Rate's going up. They're like, oh, I rented for 3 years. And you know what I'm saying? That's what it was. Okay. In Minnesota, they probably were able to keep their house for 3 or 4 years and didn't pay a payment. That was their fault.
Crazy.
I think a lot of things have changed. Well, I know a lot of things have changed. And I think that a majority, if not more than a majority, I don't know what that is, but have equity in their house. So if they needed, they could, there's room in there to sell it. In 07 and 08, if somebody wanted to sell their house, they were upside down already.
Yeah.
They couldn't even sell it.
Right.
They'd have to pay money to leave. The crash, I don't know. Maybe financially, maybe on, look at the credit card piece where they're like, hey, we're gonna max this out at 10% for an interest rate for a credit card. I think that's good. Our credit cards are still going to put their money out there, and are they still going to take that chance with people not paying?
Exactly.
So who knows, right? I mean, that aspect
Yeah.
of it. So on the housing side, I'm not going to say I know,
Yeah.
but the likelihood of it is less because of the fact that they're doing better things with the loans that are being given out. There's more money that's being put down, and there's equity positions in homes where there wasn't before.
Interesting. Yeah. Crazy.
Yeah.
Thoughts on that?
I agree. I mean, for you, Boston, if just to elaborate on that, if you were two examples of that, if you were able to buy a house and there was, little to no money down,
Yep.
and now you're in a pinch.
Already have 4 of them, right?
Yeah.
Versus if you had to put, $20,000 to $30,000 down of your money that you worked hard for, are you just going to walk away from it? Or are you going to be more apt to stay in the house and push through and find ways to be able to hold on to that house? So that affected a lot of things, all those people walking away. Look at what it did to not only the mortgage industry, but what it did to the real estate market as a whole.
Yeah.
It took a long time to bounce back from that.
Yeah.
So I think what Travis is saying is spot on. I think we're in a different market, and I think we all learned a lot from that period.
And history doesn't repeat, it rhymes, right?
Right.
So it's not like the same exact thing. I think everybody learned a good lesson from that.
Current event that's happening right now, hopefully it happens and stays going, is they're trying to stop corporations, BlackRock,
From being able to,
buy single family homes as much.
yeah.
So that's really important because you see a lot of the markets where, you lost out to a cash buyer. Who's
Right.
got all this cash?
Yeah.
Who's got all Nobody,
Yeah.
right? I mean, there are some people, but they're big corporations.
Who's
that
got
are
all
buying
this
it.
cash?
Yeah.
Right. So they're blowing up and they're pushing up prices.
Monopoly, right?
Right. And they're trying to push the prices up so they can keep it so that when they're ready, they can sell their portfolio
Yeah.
to individuals or big corporations.
Yep.
So hopefully that kind of thing goes through. That's a really big piece to it.
I
think
hope
will
so.
help.
I mean, a big indicator of that is even what they've done with farming. A lot of the small farms, family ran farms, they can't start, they can't get going. It's the big Black Rocks, the conglomerates that own all this acreage. So yeah, it would be nice to be able to regulate that a little bit and put a stop to that.
Are the buyers today financially smart or just more desperate? Is house hacking actually smart or a TikTok hype? So we should talk about some of the social media things that are put out there, right? So I called a guy, and he does trusts, and I think trusts are something that it'd be really fun to have him on.
Yeah.
Important for families, right? So when you have a house, you don't let it doesn't go to probate. You'll get all these taxes and all these things, and all of a sudden your heirs have nothing.
Yep.
I think it's his comment to me. That's why I bring it up. He goes, I said, hey, what about this? And it was something with LLCs and an S corp and a C corp and whatever.
Yeah.
And he goes, get off TikTok and stop listening to what they have to say because 95% of it, 99% of it is BS.
Yeah.
And I'm like, yeah, I know. But you want it to be real, right? Like you're listening to these things and you're like, oh, that's cool.
Right.
Like I think that's this guy or this girl seems legit.
And not knowing like how it actually works, you're gonna like even some of the stuff that I see on there, I'm like, wow, I didn't know that. Like but
Right.
I think
and
it's important
most of the time it isn't real.
It's a hook for them to get you to sell their whatever they want.
it's a sales tactic. Maybe.
Yeah, so then you click on there and then the marketing guys,
Yeah.
right, get your information and then they back solicit you for something that you weren't even looking for.
Yeah.
Yeah.
So like look at your social media page. Look at the things that you're taking in.
Yep.
And understand what's real and what's not. And understand that if you have real questions and you want to buy a house or if you want to get a mortgage or you want to do whatever, talk to somebody that does it every day,
Yep.
not to somebody that's online that's
Yeah.
going to tell you what you want to hear.
Yep. Well,
Because that really is the biggest.
let me ask you this. I know you've been in the business for 23 years. You're pretty experienced. I think anybody could, come to you and have a pretty good conversation with you.
Yep.
Where can they find you as far as reaching out maybe to fill out an application or stuff?
So a website, these cool guys that are sitting on each side of me here built a really cool website. So www.travisgoltz.com.
And what can you find?
So much information. And there's really cool chat bot that I'm always available 24/7.
There you go.
It's crazy.
Great.
I don't sleep.
24/7. 24/7.
But that's really, and there's a lot of information on there. There's 7 or 8 different pages
yeah.
that we've got that break down a lot of different questions. Ask the chatbot the questions. I've done it. I've asked myself questions, and I come back with different answers all the time.
It's impressive how
It
much
is.
it comes back with.
It really is. Use it. Look at it. Check it out. It's really fun. There's a lot of cool information on there. There's more to come. We're going to do some cool little
Crazy
videos
stuff,
with some
yep.
other people. So that's kind of fun to add to it. But yeah, that's where you can find me.
Awesome.
Or you can just send smoke signals or something.
Right.
Yeah, why not, right? Sweet. Well, do you have anything else to say, Nate Dogg? Or
I enjoyed the podcast. As far as where you can find us, so we're the Level Up Podcast Show.com is where you can find us. So if you're a business that would like to be featured, feel free to reach out to us as well. But I think we covered a lot of good information for younger generation and really anybody that wants to buy a house and what that looks like. So appreciate your wealth of knowledge, Travis. I think you did a great job with your knowledge.
Yeah.
Through
Things
those
at me.
questions.
yeah, I was just throwing it at you, and I think you did pretty well. I think you did pretty well.
Thanks. Appreciate it.
I know I learned a lot. So,
Yeah.
But yeah, thanks guys, and have a great rest of your day. Like and subscribe.
See ya.